I'm Austin Prey, senior reporter here at Payments. Joining me today is David Foyer, the Chief Product Officer at Galileo. Thanks for joining us today, David.
Thanks for having me, Austin.
Yeah, and it's an exciting conversation. We're here to talk about kind of, a new product expansion from Galileo. You guys are expanding your buy now, pay later solution to include post-purchase options for credit and debit. And so diving kind of right into that, why are you launching this, new BNPL expansion, so to speak, or this, post-purchase installment payment option now? What about the current cardholder landscape and the opportunity stood out to you most?
Yeah, so I think if we look at the research, what we're seeing is that BNPL usage is expected to surpass 900 million users globally by 2027. So there's this groundswell of demand, and we wanted to take that and kind of look at it and say, what are the needs of users there, and how are we able to solve those problems? And the way we see it is that this is like a gap bridging product. So we offer the seamless transition between like card usage and financing that's more similar to a loan, which allows you to deepen customer relationships. And from our perspective, it's being able to capture that micro moment where a user looks at their bill and sort of wants to decide, do I want this charge to come out of my bank account, or do I want this charge to be paid for differently? And how we can sort of get into that micro moment and really offer our clients the ability to deliver that to their end users. So it's not really a crowded space. We see a ton of BNPL in general, but we don't see a lot of post-purchase buy now, pay later. And so there's this really great opportunity for banks and fintechs that are looking to differentiate, to capture that micro moment and deliver that to their customers.
Awesome. And building on that last point a little bit, kind of, how does this new offering expansion help meet the top needs of these banks, these fintechs? And kind of a two-part here, broadly speaking, it's only been out for a few days, but I'm sure you guys did some pilots. Kind of, what has the initial reaction been like?
Sure. So starting at the top, I think our clients and prospects are telling us the number one thing that they are challenged with is differentiation. What makes their offering different from another offering? Because at the end of the day, it seems like all the neobanks and all the traditional banks offer very similar products with similar interest rates. And being able to say that our interest rate is an eighth point higher than a competitor is not sufficient to drive real customer demand and real customer interest. And so being able to add like unique value to your offerings to enhance both the competitive advantage and the opportunity for strategic differentiation in the market has been something that's super interesting to clients and prospects. The second one, I think, is opportunities for additional revenue growth, because as we move from a zero interest rate environment to a much higher interest rate environment, and there's, we obviously know interest rates are going to come down somewhat, but obviously the environment is different. There's this need for additional revenue streams because of costs of capital. And so being able to take installment fees and leverage that as a new way of driving revenue has been super interesting. I think the third one is, there's a lot of fintechs that want to get into lending, but can't, because lending tends to be highly complex, and there's all these different pieces around origination and management and securities for secured lending and all of that. And and simply jumping into credit card puts you back in the non-differentiated loop. And so being able to get into lending without having to become a full-fledged lending provider by shipping one or two lending products like post-purchase BNPL is a great way for providers to understand what it means to be a lender, how to lend some money, what delinquency rates look like, and really what the revenue opportunity is there. So that's, I think, sort of what are the top needs and how we're meeting them. In terms of initial reaction, it's been incredibly positive. We actually didn't know whether post-purchase BNPL would be more popular than traditional BNPL products. And in fact, what we're seeing is it is. We typically build in response to client demand. We try to get ahead of the market, but we do look for those signals. And as a product person, of course, it's always about sifting through the signals and sort of understanding what's real and what's not. But there's tremendous demand. We simply we're struggling to keep up with it, which is great. And just traditional banks and fintechs are both strongly expressing that they want to understand this product and how it's different from their other traditional products and how it's different from BNPL. So that's been great.
Awesome. And then just at a high level, the payments landscape has been transformed kind of in recent years. There's been like a seismic shift of digitization. It's honestly unrecognizable from where it was 10 years ago, even 5, 3, maybe even 2 years ago. Against kind of that dynamic backdrop, what is new or what has changed about the importance of offering, these cardholder benefits?
Yeah, that's a really interesting one that we're both participating in as obviously a member of society and a company serving the market, right? So I think, in terms of personalization, there's this new expectation that customers have where they expect highly customized services. And so if you think of sort of the way social media has done that and the way a lot of traditional retailers have leveraged CRM to create these highly personalized experiences. So when you log in as yourself, you get a customized product catalog and sort of it services the offers that are relevant to you. In financial services, there's been this competitive push to bring that level of personalization to meet consumer expectations. And we see that also, affecting lending, particularly when it comes to decisioning. So banks are being proactive about which offers to lend to which clients because the banks know sort of what the cash position is of their customers and what products are appropriate for the customers in those roles. And so a lot of this has to do with the strive for personalization, the consumer demand, and really the market expectation that products are personalized to that level. The second one I think that's happening that's super interesting is that we're seeing this change in spending habits, particularly in a post-pandemic world, we sort of see this need for flexibility and a lot of consumer focus on benefits and rewards and responsible spending, and sort of understand why are they buying what they're buying, and are they being cognizant about their purchases, and trying to find a transparent structure around budgeting and purchasing. And that to us means, when we talk about our mission to help customers connect with their money, a lot of that is about transparency. And what we're seeing is, particularly for Gen Z, they simply don't want a credit card because they can't predict when they'll be able to pay back what on their credit card, what the impact of the compound interest will be, how that all works. And so we're seeing Gen Z gravitate more toward debit cards, but of course, leveraging tools like BNPL. And when we start to do research in the market and talk to them, a lot of what we're finding is that the transparency around a fee is much clearer than it would be around compound interest. So if they know they've got to pay $20 and pay it back in 4 installments, and they know what their monthly salary is, they can simply figure that out. It's easier to calculate, it's more transparent, and it helps them with budgeting. So I think there's that as well. It's personalization and the expectations of Gen Z who are not users of credit card and who want more clarity and predictability around their spending habits and associated sort of overhead.
Awesome. Yeah, I think that's a great answer. And maybe going back 5 years, 8 years, even 3 years ago, kind of what has stayed the same about the importance of offering these cardholder benefits?
Banking is not new. Banking has been around. We have tablets from Mesopotamia from 3,500 years ago that show T-charts of commerce. I don't think there's anything new in financial services per se, right? I think what's really stayed the same is that at the end of the day, customers need access to liquidity. They want to make decisions about that access. They don't necessarily want to feel as if it's an impulse buy, or if they make a mistake, there's a punitive sort of a punitive fee around making a mistake because they didn't have that clarity. So I think at the end of the day, what customers are really thriving and what they have, what customers are really demanding and what they have demanded for quite some time is the ability to understand what they want to buy, how much it's going to cost, can they afford it, and what's their overall financial picture. And that really hasn't changed. I think what's really changed specifically is that we know there's regulatory shifts on the horizon, and that there's a shift in favor of customers and protecting customers, and that's terrific. We think there's a significant growth trajectory around services offered online because, whereas 20 years ago, banks were putting branches around town and around, shopping centers because that's where people were spending 3-4 hours a day. And so the banks wanted to be there where customers were. Now those same customers are spending 3 to 4 hours a day online. And so the banks are trying to figure out, how do we get that same presence in somebody's online journey and somebody's digital journey, and inserting themselves there. And part of that's the embedded finance thing, which is super interesting. But part of that is simply, if customers are going to be in their digital interface for the same amount of time, what does the virtual branch look like? How do you get to a customer flow, and how do you sort of disappear but stay relevant when a customer needs you? And I think that is a lot of what stayed the same and just simply changed its shape.
Yeah, that's a great response. And I do agree that, sometimes that opacity around the offerings can, feel punitive. And so it's nice to have that transparency. And just, particularly as, consumers, generational cohorts even are looking to build that kind of 360-degree financial picture. And so, you mentioned 900 million kind of at the start of the conversation. As it relates to, buy now, pay later offerings and things like these post-purchase installment payment abilities. Kind of where do you see the landscape today, and where do you see it going, in the next 1, 2, 3, 4, 5 years?
Yeah, so I think there's a couple things that are really affecting the landscape today, right? The first is the speed of technological innovation and integration, and a lot of that has to do with banks looking at their banking core and saying, you know what, we need to innovate. We need to innovate more quickly, and our legacy technology is holding us back. A lot of that has to do with the pervasiveness of, let's say, obviously smartphones, but cloud computing, internet connectivity, all of that really helping banks provide a faster loop around technology innovation. So where you see a new version of your favorite app coming out every week, banks aren't waiting a year and a half to roll out new products. They're saying we have to be able to roll out products more quickly, and so they're leveraging APIs and other technology facets to be able to do that. So I think technology innovation is definitely contributing and driving speed to market. I think there's a lot more consumer trust and transparency, and we've talked about that a little bit, but maintaining clarity and fairness around sort of what you're offering, how much it costs, and what's the overall financial impact to you as a consumer is super important. And again, a lot of that has to do with it's hard to calculate interest, particularly compound interest, and so creating a fee model really helps create that clarity and understand the full costs. And that's that's innovation that we're seeing in the landscape. And then lastly, regulatory compliance, collaboration, really proactively engaging with regulatory changes, right, is going to be important, and it already is important. Understanding the regulations to stay compliant, but also what they're trying to champion on behalf of consumers, and really kind of understanding what the regulatory structures are meant to do around gaining consumer confidence and going in that direction. I think that's certainly a change in the market landscape. Whereas, let's say 10 to 15 years ago, I think the regulators were struggling to keep up. I think now the regulators and companies are much more in lockstep with each other, moving together to enhance the customer experience. So I think that's those are some examples of where I see the current landscape having an impact.
Awesome. I mean, there's some great examples. I mean, probably already touched on a few of these, but I have another two-part question here. Kind of, when you look at the growth levers or even, potential bottlenecks of kind of, adoption of these innovative solutions, kind of, what do you see? Is it, can merchants just kind of, implement this right away? Are banks kind of, ready to go? What are some drivers that you've had your eyes on?
Yeah, so I think the first one, which I alluded to, was that product adoption in the banking space is not necessarily an easy thing. And in a lot of cases, a lot of banks have significant legacy technology, legacy processes that slow them down and make it really hard to roll out new products. So especially for traditional banks to adopt new products, it can take quite some time, and that's something that could definitely slow down product rollout. I think being able to develop API products that make sense to a traditional financial institution is challenging, but something that we do quite well. And so banks don't necessarily have to upgrade their whole stack in order to adopt a new API and ship a new API product. And so that, I think for certainly some key products, that's something that can definitely be an enabler of speed. But in the long term, I think banks are going to have to figure out how to migrate to a new modern technology stack and associated processes, and that takes time and budget and is complex. And so that's part of a journey that we're all on, right? I think the second one, which of course I alluded to as well, was regulatory challenges, right? There may be changes in regulation that can impose stricter lending standards or lending or decisioning standards, right? Which fundamentally challenge the business model here. And so if that were to happen, then that could definitely slow down adoption. And I think regulators are well aware and making very careful decisions in the space. So I'm not as worried about that, but regulatory challenges are a reality that we have to keep track of and ensure that our business models still work and are in line with compliance costs. And lastly, economic conditions. We mentioned earlier zero interest rate environment and where interest rates are now, and there's a lot of conversation around soft landing versus hard landing and what's happening around interest rates. Economic downturns and interest rates have a disproportionate influence on consumer spending and therefore lending and the attractiveness of lending, because the access to the liquidity can fluctuate significantly based on economic conditions. And so I think sort of those are the three things that we're monitoring and that we're ensuring that we're in the right sort of cadence with to make sure this is a good product and there's good product market fit.
Kind we're getting to the end here, and I have a crystal ball question for you.
Sure.
Looking ahead, it's one of the crystal balls that shows the future. If you take a glance into it, kind of what do you see as the next great innovation, or many of them, or conveniences? Just kind of what are customers waiting for? Their banks and fintechs kind of partnering with those banks to offer them. Kind of where do you see the landscape moving where do you see the landscape moving toward in the future?
BNPL and post-purchase BNPL are great, but at the end of the day, they're unsecured term loans, right? They're just one hyper-specific type of loan. And when we look at the landscape of banking and financial services, shopping for homes and mortgages and vacations and sort of there's all of these other areas where loans, and particularly secured loans, are ripe for innovation and disruption. And a lot of embedded finance has sort of been focused on CPG. So I think, when we think about the innovation, I don't think it's necessarily about what the product is per se, because I think the cast of characters on the product side in banking is quite unique and doesn't evolve that quickly. I think what does evolve is how and where, which is to say, we talked about embedded finance and sort of being in the consumer's flow. I think what's going to happen is the ability to offer products and capture those micro moments when a consumer wants it. Post-purchase BNPL is great because you've captured this micro moment where they're looking at their charge and saying, do I want to pay that out of my bank account, or do I want to take a loan to pay that off? And there's various other micro moments that can be captured as well when you're looking to buy a car, you're looking to go on vacation. How can banks and fintechs work to capture that micro moment and offer a consumer optionality in order to be able to leverage their technology to provide that liquidity at that moment? And I think that is sort of the opportunity for innovation. So the loan product itself might not change, but the form factor, the pervasiveness of being able to offer it digitally inside the customer's flow as they're going through their digital flow and provide it in a seamless way, that's something we're seeing more and more in the market. And that's something I expect to become more and more part of customer expectations over the next 5 and 10 years.
Awesome. Yeah, I mean, I think that's very exciting just on a personal level. Well, David, thank you so much for your time today.
Thanks for being here.